Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Stock that has been in focus for the last many days, DHFL. Kapil Vadhavan, the chairman and managing director of DHFL, joins us now. Kapil, thanks for joining us once again. And of course, you did reach out to investors to come out with some clarifications, etc. But just to put it on the table, you know, we were discussing with some other managements as well about the possibility of defaulting on any of the scheduled payments. Just to clarify, has DHFL defaulted on any of their scheduled payments up until now?
Absolutely not. We have not just not defaulted, but there is not even a single day's delay, and this has been a long-standing, unblemished history for the past 34 years. In fact, on the day of the mayhem as well, just to put on record, it was business as usual for us. We made a payment of almost 700 odd crores, for CP as well as some of the other bank obligations. And as we speak today, there is a 900 crore payment going today as well, to the CP holders.
Kapil, good morning. And yes, we noted ICRA giving you a AAA as recently as 48 hours ago. Now, reaffirming that rating. What is your sense about the debt markets scare? It was just a scare. Do you think they will refinance before, say, the calendar year is out and this will be forgotten?
I do hope so, because, we were actually caught in this contagion effect, which was least expected. There was a challenge with one of the other NBFCs, in the system, which actually resulted in all the mayhem that we saw on Friday. For us, it was business as usual. Our fundamentals continue to be extremely strong. Yes, I'm sure that this will tide over. We've already heard positive statements coming from the government as well as the regulators, and more importantly from the largest bank in the country.
Okay, but how much? If by when do you think this refinancing can come? Will they start picking up by, say, 6 months? And you have enough money to redeem CPs until then?
We actually went out and did an overreach with our investors. We've actually put out on the exchanges our liquidity position as well for the next 6 months.
Okay.
That even without any capital market exposure, we'll be comfortable in not just repaying all the contractual obligations that we have, but also ensure that our growth trajectory also is decently maintained. But Lata, that business does not function purely on a basis of we are an ongoing concern, and as an ongoing concern, you have to be out there wanting to continue to grow the business, and for that we obviously will go back to the bankers and seek all the undrawn credit lines that we have for us to continue with our business as usual.
What is the amount of undrawn credit lines?
So we have total of 12,000 odd crores of undrawn credit lines, as I can see here.
Okay.
It's about 12,000 odd crores of undrawn credit lines which are already approved from the banks.
Okay. What is your net worth to leverage?
Our model today is our net net worth, our net debt to equity is about 7% which is fairly comfortable. Today the NHB regulation demands or asks us to maintain a 16 times leverage. Obviously, we don't even want to or intend to get there. We have always maintained a healthy debt leverage position.
Okay, of 7 times you said.
And on a net basis, including some of our cash reserves that we have. Pardon?
You said 7 times. Your net worth, your leverage is 7 times your net worth, right?
7 times.
Okay. Okay,
That's right, yes. Net debt to leverage, net debt to equity, 7 times.
Okay. What's your, do you expect your pace of growth to get impacted for this year? What kind of a loan growth you think is possible in FY19, but more importantly in FY20?
You know, we started growing quite, you know, aggressively thanks to the PMAY, Pradhan Mantri Awas Yojana, you know, announcement by the government. And this being the government's pet project, DHFL was in the forefront in going out and lending to, you know, low ticket sized, in the low ticket size segments, low middle income segments in tier 2, tier 3 markets. Now we were obviously, you know, in the last quarter growing at a much faster pace than what we actually had grown in the previous quarters. Now obviously looking at the overall situation, maybe, you know, a 5 to 7% shave off in growth can very well be managed, but it will still be anywhere between 18 to 20%.
Okay. What about cost of funds, Kapil? What is the expectation going ahead? I mean, will you see a big jump there?
You know, honestly, I don't think that there will be a big jump in any of these matrices, and more importantly, because, you know, we were actually caught in this complete contagion effect, you know, which happened on Friday, extremely unaware of what was on the anvil. Now it's as I said, you know, till 12 o'clock on Friday, it was business as usual as far as we are concerned.
Okay.
And all of a sudden we just got caught in this entire mayhem. So
Yeah. Kapil, good morning. You know, perhaps tough for you to comment, but the buzz in the market circle is that was the fall in DHFL stock related to how Yes Bank fell, you know, initially, and that there are some related transactions. Just your thoughts on that, because that's the market chatter.
You know, honestly, as you rightly said, now these are market chatters. The number of rumors that I've seen floating around, not just on us, but from for all and sundry in the market in the last 48 to 72 hours, I haven't seen so many, you know, market rumors emanating in my entire working life, which has been more than 20 years now.
Okay, so it's not that. What's your line of credit from Yes Bank at all?
See, in the total liability pool of 51,000 crores from the capital markets, the Yes Bank exposure is about 3,700 odd crores in our long dated NCDs, and that's the only, you know, credit availability that we have from Yes.
Okay, and finally, Kapil, do you see margins now getting squeezed? If you go to banks are also in housing finance. So, you know, how do you expect your spreads to compare in FY19 vis-a-vis FY18?
See, honestly, in the last 2.5, 3 years, we have adopted a very different model of you know, funding our growth. If you see on 121,000 crores of assets under management, 1,21,000 crores, 20,000 crores of assets were actually downsold to the banks. Now, this was absolutely after, you know, the banks undertaking all kinds of diligence. You know, about 21,000 odd crores of assets were actually downsold. Now, you know, we obviously preempted and realized that the market is not deep enough for us to give the kind of liquidity to back our growth, you know, over the next, as we keep on growing at the pace that we are. You know, for this year, for example, we had anticipated, you know, a fresh lending of close to about 55 to 57,000 crores. So downselling of portfolio, which is very common in other parts of the world, was the way of also supplementing our liquidity, as well as, you know, churning our overall cash position. Sure. And a good capital efficient model. I honestly don't think that other than the market aspects on, other than the overall macroeconomic situation where interest rates have already started inching up, that's the only impact I see coming onto the DHFL cost of funds, which also can be passed on to our customers immediately as the cost of funds go up.
What is the exact exposure that you have to the loan against property segment and to builders in general?
See, our breakup of loans, is 80%, 81% of the loans is absolute retail. now, which includes the loan against property segment as well. We are extremely, efficient as far as our housing loan, exposures are concerned, and are pretty granular, because those exposures are very granular in nature. So 60% of the exposure is to absolute home loans. 21% of the exposure is to loan against property and other SME lending activities that we undertake, and about 17 or 18% is the total exposure to the developer segment.
Oh, the reason I asked is because there is some talk that RBI is planning some stringent regulations against, home finance companies that have a large exposure to the real estate segment. Is there any merit to this talk?
Honestly, these are again a part of the rumor mills that went around in the last 48 to 72 hours. RBI or our regulator NHB, they keep on, discussing with us, inspecting us. So I haven't heard anything of this sort, which may actually impede any initiatives, by HFCs to go and lend to, any particular segment.
Yeah. Even if the rule comes, it would come from NHB, obviously.